Hello. Welcome to JKO News, where you get more facts and less opinions. The Federal Reserve will announce their interest rate decision next Wednesday, February 1, 2023. The markets and analysts are expecting a 25 basis points rate hike, after some dovishness shown by Fed officials. There seems to be a willingness to wait and see the delayed effects of monetary policy. Here, I'll challenge the status quo and briefly go through two factors that might bring a surprise next Wednesday. This is just an exercise, and does not constitute investment advice. The two factors are: 1. The financial conditions have been easing over the past 3 months. 2. The broad US dollar index has been decreasing since October 2022. The Chicago Fed's National Financial Conditions Index, NFCI, provides a comprehensive weekly update on U.S. financial conditions in money markets, debt and equity markets, and the traditional and shadow banking systems. Because U.S. economic and financial conditions tend to be highly correlated, the Fed also presents an alternative index, the adjusted NFCI. This index isolates a component of financial conditions uncorrelated with economic conditions. This provides an update on financial conditions relative to current economic conditions. The NFCI and ANFCI are each constructed to have an average value of 0 and a standard deviation of 1 over a sample period extending back to 1971. Positive values of the NFCI have been historically associated with tighter than average financial conditions, while negative values have been historically associated with looser than average financial conditions. As seen on the chart, the financial conditions are getting looser and looser over the past months. This is usually associated with increasing credit, leverage, risk and stock market valuations. This set of conditions increases money velocity and might not be suited for the fight against high inflation, the fight that the Fed wants to win. The Federal Reserve dollar indexes are designed to help estimate the overall effects of U.S. dollar exchange rate on U.S. international trade. The broad dollar index is constructed using the currencies of the most important U.S. trading partners. The broad dollar index contains the currencies of 26 economies for which bilateral trade with the United States accounts for at least 0.5% of total U.S. bilateral trade. These economies are listed on the table. Because the Fed is still in the middle of the battle against inflation, if the dollar strength falls too much and too soon, the importing costs will rise, fueling inflation. Concluding, Jerome Powell has tried to keep the narrative of fighting inflation and said that the Fed might have to apply unpopular policies. However, the markets don't seem scared of Jerome Powell anymore. The easing of financial conditions and the falling dollar strength may be threats to the Fed in the fight against inflation. Thus, 25 or 50 basis points are possible next Wednesday. Over-tightening is a risk, but it's a risk the Fed is willing to take. In reality, the fast rate hikes over the past quarters may already constitute an over-tightening. If sustained for a prolonged period of time, demand destruction by bankruptcies and unemployment will eventually come. Have a nice week, and thank you for following this exercise. Please comment below. If you enjoyed this video, don't forget to like and subscribe to this channel. The content of this video is for information and education purposes only. The viewer is advised to verify the information using the cited sources.